Align loan versus bond covenants in English agent bank phrases. Welcome! In this micro lesson, we'll show how to keep loan and bond covenants marching in step. Our goals are simple. First, align covenants so the bank deal and the bond deal don't fight each other. Second, reduce conflicts across documents by spotting mismatched definitions, ratios, and baskets before they cause trouble. Third, we'll model clear agent bank phrases that make the lender docs and the indenture play nicely. By the end, you'll know what to harmonize, how to phrase it, and how to protect the company from accidental defaults created by drafting GAPs. Start with the map. A term sheet sets high-level business terms. The credit agreement translates them into operational covenants, definitions, and default mechanics. On the bond side, the offering memorandum tells the story to investors, while the trust indenture is the binding covenant package. Roles differ. The agent bank administers the loan, coordinates lenders, and manages waivers. The trustee acts for bondholders and follows the indenture strictly. Alignment means ensuring what's promised in the marketing docs appears consistently in the binding loan and bond documents. No surprises between them. First, the financial family. Tests like leverage, interest coverage, and liquidity that gate actions or trigger defaults. Next, the negative family. Restrictions on liens, debt, investments, and asset sales. The classic guardrails that limit risk. Finally, affirmative covenants and reporting obligations. Deliver financials, maintain insurance, comply with law, and certify ratios. Build a side-by-side list of each family across loan and bond docs. Where the loan permits something the bond restricts, or vice versa, flag it. Aim for parallel rules and clear carve-outs to avoid accidental breaches. Consistency starts with math. Lock in the same EBITDA add-backs and the same consolidated net debt components across loan and bond definitions. Choose one accounting basis, GAAP or IFRS, and mirror pro forma adjustment rules for acquisitions, synergies, and cost saves, including caps and timing. Then align basket sizing mechanics, especially grower baskets that scale with EBITDA or total assets. When both documents apply the same perimeter, results don't swing based on which document you read, and the business can plan confidently without running two sets of calculations. Synchronize the ratios and test dates. If leverage is measured quarterly for loans, don't let bonds measure semi-annually with a different quarter end. Default thresholds, like audit delays, cross-acceleration amounts, or payment grace periods, should match, as should cure rights, equity cures, time to deliver compliance certificates. Finally, align incurrence versus maintenance logic. Loans often use maintenance tests. Bonds rely on incurrence tests. Bridge the gap by ensuring actions permitted under one are permitted under the other at the same ratio levels, with consistent timing and look-back rules. Use one restricted payments, RP builder, across loan and bond docs. Begin with the start date. Add retained excess cash flow and permitted amounts. Subtract actual RPs. Keep the math identical. Standardize ratio-based freebie baskets. For example, unlimited RP if pro forma leverage is below a set level, and make the thresholds match. Tie debt incurrence to the same tests, including leverage or fixed charge coverage, so new debt availability in bonds mirrors loan capacity. This keeps dividends, buybacks, and new borrowing moving under the same green or red light. Use tight language to kill ambiguity. Example: for the avoidance of doubt, the indenture, Section 19, shall be interpreted consistently with Credit Agreement Section Y. To unify capacity, say, notwithstanding anything to the contrary, baskets shall be shared and applied on a first-come, first-served basis across the credit agreement and the indenture. For definitions, write, definitions are incorporated by reference and shall have identical meanings across the loan documents and the indenture, unless expressly stated otherwise. Short, clear phrases save hours of negotiation and prevent costly misreads later. Before signing, run a definition crosswalk matrix comparing EBITDA, consolidated net debt, material subsidiary, and relevant periods. Stress test baskets with sample transactions. A tuck-in acquisition, a dividend, a refinancing, confirm the same outcomes in both documents. Finally, confirm notice, waiver, and amendment paths so the agent and trustee can process changes without traps. If the covenants line up, calculations match, and decision gates trigger at the same time, you've minimized conflict risk. That's covenant alignment done right. Clean, predictable, and investor-friendly.